There is a moment in every investor's life, a defining moment that separates the journey of the amateur from the ascent of the master. It's not a moment of celebration, not the ringing of a bell on a stock exchange floor, nor the quiet satisfaction of a dividend payment hitting your account. It is a moment of pure, gut-wrenching, ice-in-your-veins terror. It is the moment the numbers on the screen turn blood red. It's the moment the talking heads on television start using words like catastrophe, meltdown, and unprecedented. It's the moment you feel the collective panic of millions of people, all rushing for the same tiny exit door, convinced that everything they have ever worked for is about to evaporate into thin air. In that single moment, your financial destiny is forged. What you do next, in the seconds, minutes, and days that follow, will determine whether you spend the rest of your life playing a game of catch-up, or whether you seize an opportunity so profound, so powerful, that it launches you onto a completely different trajectory, a path toward true and lasting financial freedom. The man who has mastered this moment more than any other, the man who has built an empire of over $100 billion by leaning into this precise moment of terror, is Warren Buffett. And the secret he has perfected is not some complex algorithm or a guarded Wall Street formula. It is a simple, profound, and transformative principle. He understands that the moment of maximum fear is also the moment of maximum opportunity. He doesn't fear market crashes, he waits for them. He cultivates them. He uses the widespread panic of the masses as his personal signal to deploy capital, to acquire pieces of wonderful American businesses at prices that seem, in retrospect, like an impossible dream. This is not just an investment strategy. It is a complete psychological reprogramming. It is the art of training your most primal instincts to do the exact opposite of what they are screaming at you to do. It's about learning to view the chaos of a market crash, not as a risk, but as a sale. A once-in-a-decade, everything-must-go clearance event on the greatest wealth-generating assets the world has ever known. Today, we are going to deconstruct this CEO mindset. We are going to build from the ground up the psychological framework and the practical blueprint that allows you to stop being a victim of market volatility and start becoming its beneficiary. We will move beyond the theory and into the tactical execution, exploring the 5 pillars that uphold this entire philosophy of crisis investing. By the end of our journey today, you will never look at a sea of red on your screen the same way again. You will see it not as a threat, but as the final promise of your financial independence. Our first pillar, the absolute bedrock upon which this entire empire of wealth is built, is not about numbers or balance sheets. It has nothing to do with price-to-earnings ratios or discounted cash flow analysis. It is the most difficult yet most important pillar to master, the foundation of fear, the art of achieving supreme emotional discipline. To understand this, we must travel back to the darkest days of the modern financial era. The year is 2008. The month is September. The global financial system is not just cracking, it is shattering. Lehman Brothers, a 158-year-old institution, has just vaporized in the largest bankruptcy in American history. The next day, the insurance giant AIG, a company with tentacles reaching into every corner of the global economy, is on the brink of a similar collapse, requiring an unthinkable $85 billion government bailout just to survive the week. The stock market is in a freefall. The Dow Jones Industrial Average is plummeting hundreds of points, day after day. Confidence has evaporated. Credit markets are frozen solid. Banks don't trust other banks, and nobody trusts the system. The fear is palpable. It's a physical presence in the air. People are pulling their money out of everything, convinced that the only safe place is under a mattress. The media is a firestorm of panic, with headlines forecasting a second Great Depression. This was not a correction. This was not a downturn. This was, in the minds of almost everyone on the planet, the end of the financial world as we knew it. And in the midst of this howling hurricane of fear, what was the Oracle of Omaha, Warren Buffett, doing? He was not selling. He was not hiding. He was writing. On October 16, 2008, with the market continuing its terrifying descent, the New York Times published an op-ed piece by Buffett. The headline was simple, direct, and an act of supreme defiance against the reigning sentiment of the entire world. It read, "Buy American, I am." Think about the courage that required. At a time when the most respected financial minds were predicting utter ruin, when the very machinery of capitalism seemed to be grinding to a halt, Buffett publicly announced he was moving his personal funds, not Berkshire's, his own money, out of safe government bonds and into American stocks. He wrote, and I quote, "A simple rule dictates my buying. Be fearful when others are greedy, and be greedy when others are fearful." He went on to explain that the long-term prospects of America's great companies had not been diminished by the panic. He acknowledged the headlines were terrifying, but stated clearly, "Bad news is an investor's best friend. It lets you buy a slice of America's future at a markdown price." He was not just saying this, he was living it. In the weeks surrounding that op-ed, Berkshire Hathaway was deploying billions of dollars. They struck a now legendary deal with Goldman Sachs, injecting $5 billion into the beleaguered investment bank in the form of preferred stock that paid a stunning 10% dividend and received warrants to buy more stock at a fixed price. It was a lifeline for Goldman, but for Berkshire, it was an absolute masterstroke of crisis investing, a deal only possible because they had the capital and, more importantly, the nerve to act when no one else would. This anecdote is the perfect encapsulation of our first pillar. Emotional discipline isn't a passive trait, it's an active, offensive weapon. It's the ability to detach your decision-making process from the emotional contagion sweeping the globe and to operate on a plane of pure logic and long-term perspective. Buffett saw the same headlines everyone else did. He felt the same uncertainty. But his mind was trained to interpret that fear not as a signal to retreat, but as the ringing of a dinner bell, signaling that a feast of opportunity was about to be served. The reason Buffett's approach is so effective, and so incredibly difficult for the average person to replicate, lies deep within the wiring of the human brain. The underlying psychological principle at play here is a powerful cocktail of two cognitive biases: loss aversion and herd mentality. Let's break these down. Loss aversion, a concept first identified by psychologists Daniel Kahneman and Amos Tversky, describes a fundamental asymmetry in how we process gains and losses. Studies have shown that the pain of losing a dollar is psychologically about twice as powerful as the pleasure of gaining a dollar. Your brain is hardwired for survival, and over millennia of evolution, avoiding a threat, like a predator, was far more important than securing an opportunity, like finding a fruit tree. A missed meal is a shame. Being the meal is the end of your genetic line. This ancient survival circuit is still running the show in your brain when you look at your investment portfolio. When the market is crashing, that red arrow pointing down doesn't just represent a financial loss. It triggers the same primal fear pathways as a physical threat. Your amygdala, the brain's alarm center, goes into overdrive. It screams, "Danger! Sell! Get to safety!" This is why panic selling feels so viscerally correct. You are literally acting on a deep-seated instinct to flee from pain. Now, compound that with herd mentality. Human beings are social creatures. For most of our history, being part of the tribe was essential for survival. Being cast out meant certain death. As a result, we have an overwhelming instinct to conform, to do what the group is doing, because it feels safe. When the market is crashing, the herd is selling. Your friends, your colleagues, the news anchors, the online forums, everyone is screaming that the sky is falling. To stand against that tide, to buy when every single person around you is selling, is an act of profound social defiance. Your brain interprets this as isolating yourself from the tribe, which feels dangerous and wrong, so you have this perfect storm of cognitive bias. Loss aversion is screaming at you to stop the personal pain by selling your stocks. Herd mentality is screaming at you to follow the crowd to perceived safety. Acting rationally, seeing the crash as a sale, requires you to consciously and deliberately override these two powerful, deeply ingrained instincts. This is not a matter of intelligence. You can be a certified genius and still fall victim to these biases. It is a matter of psychological training and having a predefined system. Buffett has spent a lifetime conditioning himself to recognize the feeling of fear not as a signal to act, but as an external data point about the emotional state of the market. He feels the fear, acknowledges it, and then uses it as a contrary indicator. The more fear he sees in the market, the more greedy or aggressive his system tells him to be. He has effectively rewired his brain to associate the market's panic with his own personal opportunity. This is the essence of mastering the foundation of fear. It's not about being fearless, it's about acting correctly in the face of fear. So how do we as retail investors, as entrepreneurs managing our own capital, translate this into a practical, applicable mental model? How do we build our own psychological fortress? The blueprint for this is what I call the emotional circuit breaker. It's a system you design during times of calm that you are forced to follow during times of chaos. It consists of 3 key components. Step 1 is to write a personal investment policy statement, or an IPS. This sounds formal, but it's critically important. It's a short document, maybe 1 or 2 pages, that you write for your future, panicked self. In it, you define your financial goals, your time horizon, which for a long-term investor should be in decades, not months, and your core investment philosophy. Most importantly, you must include a section called "In Case of Market Crash." In this section, you write down specific rules. For example, if the S&P 500 drops by 20%, I will not sell any of my core holdings. Instead, I will deploy the first tranche of my cash reserves according to my predefined shopping list. You sign and date this document. When a crash happens and your heart is pounding, you are instructed to pull out this document and read it before making any decisions. It's a letter from your calm, rational self to your terrified, emotional self, reminding you of the plan. This simple act creates a crucial pause, a gap between the emotional stimulus and your response, allowing your rational brain to come back online. Step 2 of the emotional circuit breaker is pre-commitment. You must decide in advance exactly what you will buy and at what price. We will cover this in detail in a later pillar about building a shopping list, but the emotional component is key. You need to do the stock analysis and research when the sun is shining. You identify 5 to 10 wonderful businesses you'd love to own for the next 20 years. You calculate their intrinsic value and determine 3 price targets at which you'd be ecstatic to buy them: a good price, a great price, and a once-in-a-generation price. You can even set limit orders with your broker for these prices, far below the current market price. This automates your courage. When the crash comes, you're not trying to think and analyze amidst the panic. The thinking is already done. Your job is simply to execute a plan you made when you were at your most logical and objective. Step 3 is to curate your information diet. During a crash, the financial media is not your friend. It is an engine designed to monetize your fear. Every headline is engineered for maximum emotional impact. Your blueprint requires you to go on a strict media fast. Unfollow the fearmongers on social media. Turn off the 24-per-hour news channels. Instead, commit to reading primary sources, the annual reports of the companies on your watch list, or timeless books on value investing like The Intelligent Investor. By deliberately unplugging from the panic machine, you create a mental clean room where your rational plan, your IPS, and your pre-committed buy orders can be executed without the corrosive influence of the herd's terror. This 3-part system, the policy statement, the pre-commitment, and the information diet, acts as your circuit breaker. It doesn't eliminate fear, but it contains it. It channels it. It ensures that your actions are dictated by your long-term strategy, not by the short-term noise of a panicked market. To truly appreciate the power of this emotional discipline, we must look at its opposite. We must examine the path of the 99%, the antithesis of the Buffett mindset. This is the path of the panic seller. Let's create a profile of this individual. It's March of 2020. A global pandemic has brought the world to a standstill. The stock market is experiencing the fastest 30% drop in its history. Our investor, let's call him Tom, has a decent portfolio he's been building for a decade. He watches the news every night. He sees the terrifying charts. He reads articles about overwhelmed hospitals and broken supply chains. His friends are all talking about how this is the big one, how the economy will never recover. His loss aversion is firing on all cylinders. Every day he logs into his account, his stomach drops as he sees his life savings shrinking by 5%, then 10%, then 20%. The pain is unbearable. The herd mentality kicks in. He reads a headline. Experts say, sell everything before it's too late. He sees a famous hedge fund manager on television saying, cash is king. He can't take it anymore. The need to do something to stop the pain becomes overwhelming. He logs into his brokerage account and hits the sell all button. The moment he does it, he feels a wave of relief. The pain has stopped. He's safe in cash. He has protected what's left. But what has he actually done? He has taken a temporary, on-paper loss and turned it into a permanent, real-world loss of capital. He sold shares of world-class companies, not because their long-term earning power was impaired, but because he was scared. Now the second part of the tragedy unfolds. The market, as it always does, finds a bottom. It happens when the fear is at its absolute peak. Then it begins to rebound. At first, Tom is smug. He thinks, this is a dead cat bounce, a sucker's rally. It's going to crash even lower. He stays in cash, feeling smart. But the market keeps rising. It recovers 10%, then 20%. Now, a new emotion takes over, the fear of missing out, or FOMO. He's torn. He sold near the bottom, and now he feels foolish. He can't bring himself to buy back in at prices that are 20% higher than where he sold. So he waits. He waits for another dip that never comes. The market recovers all of its losses and then goes on to make new all-time highs. Tom is still sitting in cash, his wealth permanently impaired. He not only locked in his losses, but he also missed the single greatest wealth creation opportunity of the decade. This story is not an exaggeration. It is the lived experience of millions of investors in every single market crash in history. They sell out of fear and then are paralyzed by indecision on the way back up. They violate the cardinal rule of investing: buy low, sell high. Instead, they do the exact opposite, driven entirely by undisciplined emotion. This is the path of the 99%. It is a guaranteed road to mediocre returns and a lifetime of financial regret. It is the antithesis of everything Buffett stands for. The financial consequences of these two opposing paths are not small. They are staggering. The direct financial connection between emotional discipline and wealth is one of the most powerful forces in capital markets. Let's quantify it. Imagine two investors on January 1, 2008. Both start with a $100,000 portfolio invested in a simple S&P 500 index fund. Investor A is our panic seller, Tom. Investor B is our disciplined investor, who follows the Buffett model. The 2008 crisis hits. By the market bottom in early March 2009, the S&P 500 has fallen by roughly 55%. That $100,000 portfolio is now worth about $45,000. The fear is immense. Investor A, the panic seller, can't take it anymore. He sells everything on March 9, 2009, the very bottom, locking in a $55,000 loss. He walks away with $45,000 in cash, feeling relieved to have saved something from the wreckage. He stays in cash, too scared to get back in. Now consider Investor B, the disciplined investor. She feels the same fear, but she refers to her investment policy statement. It tells her to hold on and, if possible, buy more. Let's be conservative and say she doesn't even have extra cash to invest. She simply does nothing. She holds her $45,000 worth of stock. What happens next? The market begins a historic rebound. By the end of 2010, just a year and a half later, the S&P 500 has more than doubled from its low. Investor B's portfolio is now back above $100,000. Investor A is still sitting on his $45,000 in cash, having missed the entire recovery. The gap between them is already over $55,000. But the real magic, the true financial power, comes from the long-term compounding that follows. Let's fast forward to today. That $100,000 that Investor B held through the crisis would have grown with dividends reinvested to over $500,000. Investor A, our panic seller, is still sitting on his $45,000, which has actually lost purchasing power due to inflation. The difference in their financial outcomes, stemming from a single set of decisions made during a few terrifying months, is nearly $500,000 on an initial investment of $100,000. This isn't a clever trading strategy. It's the direct, quantifiable result of mastering one's emotions. It is the financial manifestation of being greedy when others are fearful. The market crash didn't destroy Investor A's wealth. His reaction to the market crash did. And it propelled Investor B onto a path of accelerated wealth creation that the panic seller may never be able to catch up to. This is the true financial connection. Mastering this first pillar isn't just a nice psychological trick. It is the single most important variable in your long-term journey of building wealth and achieving financial freedom. The second pillar that supports this crisis investing framework is the preparation principle, which can be summed up in one powerful phrase: the power of the cash hoard. It is the tactical arm that allows the emotional discipline we just discussed to be put into action. Being greedy when others are fearful is a wonderful aphorism, but it's utterly useless if you don't have the ammunition to act. You cannot buy the sale of a lifetime if your wallet is empty. This is where Buffett and Berkshire Hathaway are absolute masters. They view cash not as a lazy asset that earns nothing, but as a strategic weapon, a call option with no expiration date on future bargains. They are comfortable, even happy, to hold tens of billions, sometimes over $100 billion in cash and short-term treasuries, even when bull markets are raging and pundits are criticizing them for missing out. They understand that the returns they give up by holding cash in good times are dwarfed by the incredible opportunities that cash provides in bad times. A perfect illustration of this principle unfolded during that same 2008 financial crisis. While most companies and investors were fully leveraged and desperate for liquidity, Berkshire Hathaway was sitting on a mountain of cash. This position of strength allowed Buffett to become not just a stock picker, but the lender of last resort to corporate America. He wasn't just buying stocks on the open market. He was getting private calls from the CEOs of the world's most powerful companies. In late September 2008, Goldman Sachs was facing a crisis of confidence. Even though their books were stronger than other banks, the market was punishing them. They needed a vote of confidence, and they needed capital. So CEO Lloyd Blankfein called the one person he knew had both the money and the reputation to calm the markets: Warren Buffett. The deal they struck was a masterpiece for Berkshire. As mentioned, Berkshire invested $5 billion in Goldman Sachs preferred stock. This wasn't common stock. It was a special class of stock that paid a guaranteed 10% dividend per year. That's $500 million in cash flow annually, a fantastic return in any environment, let alone one where interest rates were heading to zero. But the real genius was in the second part of the deal. Berkshire also received warrants that gave them the right to buy $5 billion worth of Goldman's common stock at a price of $115 per share, any time over the next 5 years. At the time, Goldman's stock was trading around that price, but Buffett knew that once the panic subsided, it would be worth far more. He was right. Goldman survived and thrived. A few years later, Berkshire exercised those warrants when the stock was trading far higher, netting a multi-billion-dollar capital gain on top of the hundreds of millions in dividends they had already collected. This deal was impossible for any normal investor. You couldn't just go online and buy these special shares. It was only available to Buffett because he had a massive hoard of cash ready to deploy at the exact moment when capital was the scarcest and most valuable commodity on the planet. He repeated this feat just a few years later in 2011, during a smaller market panic surrounding the U.S. debt ceiling crisis and fears about European bank stability. Bank of America's stock was getting hammered. So Buffett picked up the phone, called CEO Brian Moynihan, and proposed a similar deal, a $5 billion investment in preferred stock yielding 6%, plus warrants to buy 700 million shares of common stock at just over $7 a share. Over the next several years, Bank of America's stock soared. Berkshire's investment turned into a profit of more than $12 billion. These two deals, Goldman Sachs and Bank of America, generated over $20 billion in profits for Berkshire Hathaway. These profits were not the result of brilliant stock analysis in the traditional sense. They were the result of having a prepared mind and, crucially, a prepared bank account. It was the cash hoard that gave him a seat at the table when no one else could even afford to be in the room. The psychological principle that makes maintaining a cash hoard so difficult for the average investor is a combination of present bias and the relentless fear of missing out, or FOMO. Present bias is our natural tendency to overvalue immediate rewards at the expense of long-term gratification. Your brain prefers the small, certain pleasure of today over the large, uncertain pleasure of tomorrow. In investing, this manifests as a desire to be fully invested at all times. The idea of cash sitting in an account, earning next to nothing while the market is climbing, feels like a mistake. It feels like you're losing. Every day the market goes up, the pain of being partially in cash intensifies. You see others celebrating gains, and you feel like you're being left behind. This is FOMO. It's a powerful socially driven emotion that pushes you to take risks you otherwise wouldn't. It's the voice in your head that says you have to be in the game to win. Get that cash invested now before the market runs away from you. This pressure leads to a behavior known as performance chasing. Investors pile into whatever is hot, pushing their asset allocation to 100% stocks or even into leverage at the very peak of a bull market. They are maximizing their exposure at the point of maximum risk. Buffett's strategy is the polar opposite. He practices delayed gratification on an epic scale. He is willing to endure years of underperformance and criticism for holding cash, because he is not focused on the present pleasure of capturing every last percentage point of a bull market. He is focused on the future massive pleasure of being able to buy assets at 50 cents on the dollar during a panic. He understands that cash has an option value. In normal times, its value is low. But during a crisis, the value of that cash, the value of that liquidity explodes. It becomes the most powerful asset in the world. To cultivate this mindset, you have to fundamentally change your view of cash. Stop seeing it as a, quote, zero-yielding asset. Start seeing it as a zero-cost call option on future market crashes. Each dollar you hold in reserve is a ticket to a future sale. It is your dry powder, your strategic reserve. Overcoming present bias requires a conscious shift in your time horizon. You are not investing for this year. You are building wealth for the next 30 years. And over a 30-year period, you are virtually guaranteed to experience several major market panics. The question is not if they will happen, but if you will be prepared when they do. The investor who is 100% invested at all times is essentially betting that the good times will last forever. The prepared investor, the one with a cash hoard, acknowledges the cyclical nature of markets and patiently waits to capitalize on the inevitable downturns. This psychological shift from viewing cash as a drag to viewing it as an opportunity is fundamental to successfully implementing this pillar of the Buffett strategy. So how do we apply this principle? How does a retail investor or an entrepreneur build and manage their own strategic cash reserve? The mental model for this is the Strategic Cash Deployment Plan. It's a formal system for building up and deploying your dry powder. Step 1 is determining your target cash allocation. This is a personal decision, but a common framework for a long-term investor might be to hold somewhere between 10% and 25% of their investment portfolio in cash or cash equivalents like short-term treasury bills. This is not your emergency fund, which should be a separate bucket of 3 to 6 months of living expenses. This is dedicated, quote, opportunity capital. You decide on your percentage during a time of calm and write it into your investment policy statement. For example, my target asset allocation is 80% equities and 20% strategic cash. Step 2 is to automate the accumulation of this cash. The easiest way to fail is to rely on willpower. Instead, set up an automatic transfer every month from your main checking account to a separate high-yield savings account that you label Opportunity Fund. This makes the process mindless and consistent. You are paying yourself first, building your dry powder brick by brick. When the market is high and booming, and you are tempted to invest this cash, the fact that it's in a separate account adds a layer of friction, giving you a moment to pause and remember its strategic purpose. Step 3 is to redefine what investing means. When you receive a bonus or a windfall of cash, your first instinct might be to immediately invest it all in the market. With this new model, you first use that windfall to top up your opportunity fund to its target allocation. If your target is 20% cash, and your portfolio has grown to a point where your cash is only 15% of the total, you allocate new capital to cash first until you're back at your target. This creates a natural counter-cyclical behavior. As the market rises and your stocks become a larger portion of your portfolio, you are automatically directed to allocate more to cash. Conversely, after a crash, when you've deployed your cash and it's below your target, you will be rebuilding your cash hoard while assets are still relatively cheap. This system forces you to be disciplined, preventing you from getting swept up in the euphoria of a bull market and ensuring you are ready for the inevitable downturn. When the crash does come, this plan prevents indecision. You already know how much capital you have to deploy. The only question is when and how, which we will address in a later pillar. But the preparation, the hard work of accumulating and guarding that cash is already done. Now, let's examine the antithesis, the path taken by the vast majority of investors who ignore the principle of preparation. This is the path of the fully invested optimist. This investor, let's call her Jennifer, believes in the long-term power of the stock market, which is a good thing. But she takes it to an extreme. She believes that any cash held on the sidelines is a mistake, a cash drag that is crippling her returns. She reads articles about how time in the market beats timing the market, and interprets that to mean she should be 100% invested, 100% of the time. In the late stages of a bull market, Jennifer feels like a genius. Her portfolio is soaring. She may even take on leverage, using margin to buy even more stocks, wanting to maximize her exposure to the seemingly endless upward trend. She sees Buffett sitting on billions in cash and thinks he's an old man who has lost his touch. Then, the crash comes. It's swift and brutal. The market drops 20%. Jennifer isn't worried. She's a long-term investor. She can handle it. But then it drops 30%, then 40%. Now, a new and terrible force enters the equation, the margin call. Her broker informs her that because the value of her stocks has fallen, her loan is no longer sufficiently collateralized. She must deposit more cash into her account immediately, or they will begin liquidating her positions to cover the loan. But Jennifer has no cash. She's fully invested. She is now forced to sell her stocks. But she's not selling by choice. She's a forced seller. And she's being forced to sell at the worst possible moment, into a waterfall decline, at prices she knows are ridiculously cheap. She is selling at the exact moment Warren Buffett is beginning to buy. The dream of using the crash as an opportunity is gone. The crash is now a personal financial catastrophe. Even if she's not on margin, the psychological pressure on the fully invested optimist is immense. She sees the sale of a lifetime happening, but she is powerless to act. She has no ammunition. All she can do is watch, white-knuckled, as her net worth evaporates, hoping for a recovery. The feeling of helplessness is profound. She made the mistake of confusing optimism with a lack of preparation. She planned for only one type of market, one that goes up. When reality inevitably proved more complex, her strategy shattered. This is the fate of those who disdain cash. They ride the bull with glee, but are gored and trampled when the bear inevitably arrives. They miss the single greatest advantage a long-term investor has, the ability to turn a market crisis into a personal fortune. The direct financial connection of this principle is a tale of two different worlds. Let's quantify the impact of having a prepared cash hoard. Imagine our two investors again, Investor B, the prepared investor, and Investor C, the fully invested optimist. Both have a $100,000 portfolio at the start of 2008. Investor C is 100% in an S&P 500 index fund. Investor B follows our strategic cash deployment plan and is 80% in the S&P 500 $80,000 and 20% in cash, $20,000. During the bull market leading up to 2008, Investor C would have slightly outperformed. Her $100,000 in stocks would have grown faster than Investor B's $80,000. This is the cash drag that makes this strategy so psychologically difficult. Investor C feels smarter. Now the crash. By March 2009, the market is down 55%. Investor C's portfolio has fallen from $100,000 to $45,000. She has no cash to deploy. She can only hold on. Investor B's portfolio has also fallen. Her $80,000 in stocks is now worth about $36,000. However, she still has her $20,000 in cash. Her total portfolio value is $56,000. She is already $11,000 ahead of Investor C, simply because her cash acted as a buffer. But now, the magic happens. She executes her plan. Seeing the market down over 50%, she decides this is a generational buying opportunity and deploys her entire $20,000 cash hoard into the S&P 500 at the bottom. Her total investment in the market is now $56,000. Now let's watch the rebound. The market doubles over the next 18 months. Investor C's $45,000 investment doubles to $90,000. She is still down 10% from her starting point. Investor B's $56,000 investment doubles to $112,000. She is not only fully recovered but is now significantly ahead. Her decision to hold cash and deploy it strategically has completely changed her financial trajectory. Let's zoom out to the long term. By today, Investor C's initial $100,000, which fell to $45,000, would have grown to around $450,000. A fantastic return. But Investor B's portfolio, turbocharged by that crisis deployment of capital, would have grown to over $560,000. The difference is more than $110,000. That is the direct, quantifiable financial return on being prepared. The so-called drag of holding cash in the good years was paid back tenfold by the propulsion that cash provided during the bad years. This demonstrates that superior wealth management isn't just about capturing upside. It's about having the tools to strategically capitalize on the downside. The cash hoard is not a sign of fear. It is the ultimate expression of a CEO mindset, transforming you from a passive participant in the market's whims to an active, opportunistic owner of capital. Having mastered our emotions and prepared our capital, we now arrive at the third pillar, the intellectual core of the operation, the shopping list. This is the principle of identifying wonderful businesses before the sale begins. A market crash is a store where everything is suddenly marked down 50%, but not everything is a bargain. Some items are on sale because they are defective and about to be discontinued forever. Others are high-quality, durable goods that will last a lifetime. The job of the intelligent investor, long before the crash ever happens, is to walk the aisles of the store, study the merchandise, and make a very short, very specific shopping list of the high-quality goods they want to own. This way, when the panic-driven sale begins, you're not running around frantically trying to figure out what's good. You're walking calmly to the specific aisles you've already identified, with your list in hand, ready to buy your chosen items at your predetermined price. Warren Buffett is the undisputed master of this. His most famous investments are almost always in companies he has understood and admired for years, sometimes decades, before he ever invested a dollar. A foundational anecdote that perfectly illustrates this principle took place long before the 2008 crisis, back in 1963. It was called the salad oil scandal. A company called Allied Crude Vegetable Oil, a major customer of American Express, was discovered to be a massive fraud. They had been securing huge loans using barrels of salad oil as collateral. The problem was, the barrels were mostly filled with water, with only a thin layer of oil on top. When the fraud was exposed, Allied Crude went bankrupt, and it looked like American Express was on the hook for tens of millions of dollars in losses, a huge sum at the time. The market panicked. Wall Street assumed American Express was ruined. The stock was obliterated, falling by nearly 50%. Everyone was selling. The herd was in a stampede. But a young Warren Buffett saw the panic as a potential opportunity. He didn't just buy the stock because it was cheap. He began a deep dive investigation to create his shopping list analysis. He knew American Express had two core businesses: their charge card and their traveler's checks. The market was assuming that the scandal would destroy the public's faith in both. Buffett decided to test that thesis with some on-the-ground research, what investment legend Peter Lynch would later call scuttlebutt. He went to restaurants and travel agencies in his hometown of Omaha. He talked to merchants. He talked to customers. He asked them, "Are you still accepting American Express cards? Are you still using their traveler's checks?" The answer he got back was a resounding yes. He found that the brand's power and the utility of its products in the minds of the consumer were completely untouched by the Wall Street scandal. He then went to the bank and observed that competitors were actually trying to sell their own traveler's checks by claiming they were as good as American Express, implicitly reinforcing Amex's position as the gold standard. He dug into the company's financials and realized that the underlying earning power of the card and check businesses was so immense that it could easily absorb the losses from the salad oil fraud and continue to grow. He concluded that the market was making a classic mistake. It was confusing a single, dramatic, but ultimately temporary business problem with a permanent impairment of the company's core franchise. The wonderful business was still wonderful. It was just on sale due to fear. Having completed his research and put American Express at the top of his shopping list, he acted decisively. He invested over 40% of his partnership's capital into the single stock, an act of supreme concentration and confidence. Over the next few years, the market realized its mistake. The salad oil scandal faded from memory, and the incredible growth of the credit card business became the dominant story. The stock soared, and Buffett made a fortune for his partners. This story is the perfect blueprint for Pillar 3. It wasn't about timing the market. It was about knowing a business so intimately that when the market offered you a ridiculous price for it, you had the conviction to act. The psychological principles that prevent most investors from creating a proper shopping list are confirmation bias and the availability heuristic. Let's dissect these. The availability heuristic is a mental shortcut where our minds rely on immediate examples that come to mind when evaluating a specific topic. During a market crash, the available information is overwhelmingly negative. Every news story, every chart, every conversation is about collapse, bankruptcy, and loss. When you think about a company like, say, Apple during a crash, the first things that come to your mind are not its incredible brand loyalty or its fortress balance sheet. It's the headlines about falling consumer demand, supply chain disruptions in China, and a plunging stock price. Your brain gives disproportionate weight to this recent, dramatic, and readily available negative information, causing you to overestimate the risk and underestimate the company's long-term resilience. Now, layer on confirmation bias. This is the tendency to search for, interpret, favor, and recall information in a way that confirms or supports one's pre-existing beliefs. If the availability heuristic has already planted the seed of fear in your mind, confirmation bias is the water that makes it grow. You will start to subconsciously seek out information that validates your fear. You'll click on the articles with the scariest headlines. You'll pay more attention to the bearish pundits on TV. You'll ignore or dismiss any data that suggests the company's fundamentals are still strong, writing it off as out of touch or not getting it. This creates a dangerous feedback loop. The negative news makes you fearful, and your fear makes you seek out more negative news. In this state of mind, it is impossible to conduct the kind of objective, fundamental business analysis that Buffett did with American Express. You're not analyzing a business anymore, you're just rationalizing your emotions. Buffett's method of creating a shopping list, new, in advance, is a direct antidote to these biases. By doing the deep research during calm markets, when your mind is clear and objective, you form a baseline belief about a company's quality and intrinsic value. You anchor your opinion to the business fundamentals, not the market sentiment. When the crash comes and the storm of negative information rages, your anchor holds. You can look at the scary headlines and say, yes, I understand the short-term panic, but my deep research showed me that this company has a durable competitive advantage and a strong balance sheet. The storm will pass, but the fortress will remain. You are filtering the new, available information through your pre-existing, well-researched framework, rather than letting the new information create a new, panicked framework. This is how you avoid the trap of emotional reasoning and stick to the logic of business valuation, even when it feels like the world is ending. The applied mental model for building your own pre-vetted shopping list is what we'll call the Desert Island Stock Watch List. The premise is simple. If you were to be stranded on a desert island for 10 years and could only own shares in 5 to 10 companies, which ones would you choose? You wouldn't have access to stock quotes or news. You would have to be so confident in the durability and long-term earning power of these businesses that you could sleep soundly for a decade, knowing they would likely be larger and more profitable upon your return. This mental model forces you to ignore short-term market noise and focus exclusively on business quality. Here is the step-by-step process for building this watch list. Step 1. Brainstorm potential candidates. Look for companies with wide economic moats, a term popularized by Buffett. These are sustainable competitive advantages that protect a company from competitors, much like a moat protects a castle. Examples include powerful brands like Coca-Cola, network effects like Visa or MasterCard, switching costs like Microsoft, or low-cost advantages like Costco. Start by looking at your own life. What products or services do you use that are almost impossible to replace? These are often good starting points for research. Step 2. Become a financial detective. For each candidate, you must read at least the last 5 years of their annual reports, paying special attention to the letter to shareholders from the CEO. You are looking for consistent profitability, growing revenues, manageable debt levels, and high returns on capital. You're not looking for a hot stock. You're looking for a boringly predictable and profitable business. A key metric to look for is a consistent history of free cash flow, which is the lifeblood of any company. This is the stage of deep stock analysis and financial education. Step 3. Calculate a range of intrinsic value. This is the most technical step, but it's crucial. Intrinsic value is an estimate of a business's true underlying worth, separate from its fluctuating stock price. A common method is a discounted cash flow (DCF) analysis, where you project a company's future cash flows and then discount them back to the present day. You don't need to find a single perfect number. Instead, you should aim for a conservative range. This gives you concrete price targets. You can then say, I believe company X is worth between $150 and $180 per share. Step 4. Set your buying prices with a margin of safety. This is a core principle from Benjamin Graham, Buffett's mentor. You never want to pay full price, even for a great company. You want to buy at a significant discount to your calculated intrinsic value. So you set your price tiers. For Company X, your good price might be $120, a 20% margin of safety. Your great price might be $100, and your once-in-a-generation price, the one you see during a full-blown market panic, might be $80. You write these numbers down. You now have a concrete, actionable shopping list for 5 to 10 incredible businesses, complete with the exact prices at which you are willing to act. When the market crash comes, the thinking is done. Your job is not to analyze, but to execute. To fully grasp the wisdom of this prepared approach, we must examine its antithesis, the path of the falling knife catcher. This is the investor who sees a market crash not as a sale on quality goods, but as a chance to gamble on the most beaten-down, speculative stocks, hoping for a quick rebound. Let's call this investor Mike. The 2020 crash hits. Mike has no pre-made shopping list. He just sees red everywhere and thinks everything is cheap. He's drawn to the stocks that have fallen the most, the ones down 80% or 90%. He sees an airline stock that used to be $50 now trading at $5. He thinks it has to go back up eventually, right? If it just gets back to $10, I'll double my money. He doesn't look at the balance sheet. He doesn't realize the airline is burning through hundreds of millions of dollars a week, has taken on mountains of new debt just to survive, and has diluted its existing shareholders by issuing billions of new shares. He's not buying a piece of a business. He's catching a falling knife. He does the same with cruise line stocks, movie theater chains, and other businesses whose very survival is in question. He is confusing a cheap price with a good value. In investing, they are not the same thing. A company trading at $5 can still go to zero. In fact, companies with broken business models and crippling debt are the most likely to do so during a severe economic downturn. While the market as a whole eventually recovers, many of these falling knife companies do not. Some go bankrupt, wiping out shareholders completely. Others survive but are so burdened by debt and share dilution that their stock price languishes for years, never regaining its former highs. Mike, the falling knife catcher, ends up with a portfolio of broken companies. He might get lucky with one or two, but on the whole, his strategy of buying the cheapest-looking junk leads to disastrous results. He failed to do the hard work of distinguishing between a wonderful company on sale and a terrible company on its way to the graveyard. He skipped the crucial pillar of preparation and research, and his capital paid the ultimate price for it. This is a trap that snares countless retail investors in every downturn. The allure of a stock that's down 90% is immense, but it's often a siren song leading your portfolio onto the rocks. Quality is the investor's best defense in a crisis. The direct financial connection between having a pre-vetted shopping list and your long-term returns is profound. It is the difference between buying a future titan of industry and a future bankruptcy filing. Let's use the 2008 crisis as our canvas once again. Imagine two investors, both with cash ready to deploy at the market bottom in March 2009. Investor D is our falling knife catcher. Investor E is our prepared shopper with a desert island stock list. Both invest $10,000. Investor D, the falling knife catcher, sees that the banks have been hit the hardest. Citigroup, once a behemoth, has fallen over 90% to just over $1 per share. It looks like the ultimate bargain. He invests his $10,000 into Citigroup. Investor E, the prepared shopper, has done her homework. She knows that while some banks are in trouble, another company with a powerful moat, let's say Apple, is also being sold off in the panic. Apple's stock has also fallen significantly, but her research shows it has a fortress balance sheet with zero debt, a fanatically loyal customer base, and incredible innovations in the pipeline like the iPad, which would be released the next year. She sees a wonderful business on sale and invests her $10,000 in Apple. Now let's fast forward 10 years to 2019. Investor D's $10,000 investment in Citigroup would have grown to approximately $13,000, accounting for a reverse stock split. The company survived, but it was so damaged and diluted that its stock performance was anemic. A 30% return over a decade is a terrible outcome, barely keeping pace with inflation. Now let's look at Investor E. Her $10,000 investment in Apple at the 2009 low would have grown to over $200,000. The difference in outcome is not just a few percentage points, it is a life-changing amount of money. Both investors were brave, both bought during the panic, but one bought a cheap stock while the other bought a wonderful business at a fair price. The quality of the asset they purchased was the single most important factor in their long-term returns. This is why the stock picking and stock analysis done before the crisis is arguably more important than the actions taken during it. Your shopping list is your roadmap to wealth. A good list will guide you to treasures. A bad list, or no list at all, will lead you straight into the value traps and financial minefields that litter the landscape of a market crash. The financial rewards for this preparation are not incremental, they are exponential. We have now reached the fourth pillar, the moment of truth, where strategy meets action, the execution engine. This is the art of pulling the trigger in the eye of the storm. You've mastered your emotions, you've stockpiled your cash, and you have your high-quality shopping list in hand. Now, you must act. This is often the most difficult step, as it requires you to move against every screaming instinct for self-preservation. It's one thing to have a plan, it's another thing entirely to execute it when the digital ticker tape is drenched in blood. The perfect anecdote to illustrate this pillar is Buffett's behavior during one of the most sudden and terrifying crashes in history. Black Monday, October 19, 1987. On that single day, the Dow Jones Industrial Average fell by 22.6%, the largest one-day percentage drop in its history. To put that in perspective, a similar drop today would be a decline of over 8,000 points in a single session. The technological infrastructure of the market was overwhelmed. Panic was absolute. Nobody knew if the system itself would survive. What was Warren Buffett's first move? According to the accounts of his biographer, Roger Lowenstein, he did not panic. He did not rush to a computer screen. He calmly calculated in his head how much Berkshire Hathaway's net worth had just fallen, hundreds of millions of dollars. He viewed it not as a loss but as the market repricing his assets. His immediate reaction was not, "How do I get out?" but "What is now on sale?" He got on the phone with his brokers. He had been building a large position in one of his favorite companies, Coca-Cola, for some time. He had also long admired companies like the Washington Post. On Black Monday and in the days that followed, while the world was convinced the financial system was ending, Buffett was a buyer. He was methodically adding to his positions. He famously told a reporter at the time, "It's an ideal time to buy stocks. I'm buying." When asked if he was worried, he replied, "We're going to be buying on balance for the next 20 years, so when stocks go down, it's good news for us." This is the execution engine in its purest form. There was no hesitation, no second guessing. The price of an asset he already loved, based on his deep business analysis, had just been marked down significantly. The logical response, therefore, was to buy more of it. He had a prepared mind, and when the opportunity presented itself, no matter how terrifying the context, he executed his plan. He didn't try to time the absolute bottom. He just recognized that prices were suddenly far more attractive than they had been the week before, and he began to deploy his capital. He was acting on a simple, powerful logic. If you liked a business at $40 a share, you should absolutely love it at $25 a share, assuming the long-term fundamentals of the business haven't changed. The 1987 crash turned out to be a short, sharp shock. The market found its footing and began a multi-year bull run. The shares Buffett bought in the midst of that chaos went on to generate billions of dollars in capital gains and dividends for Berkshire shareholders. His ability to execute cleanly and decisively at the moment of maximum fear is a hallmark of his entire career. The psychological barriers to execution during a crisis are immense. The two primary cognitive biases at play are action bias and its polar opposite, analysis paralysis. Let's start with action bias. This is the human tendency to feel compelled to do something, even if that something is counterproductive. When faced with an ambiguous and threatening situation like a market crash, sitting still feels wrong. The emotional pressure to act becomes overwhelming. For most people, the easiest and most immediate action to take is to sell. Selling provides a sense of control. It makes you feel like you've done something to address the threat. This is why so many people panic sell at the bottom. The action itself, however irrational, provides a temporary psychological relief from the anxiety of uncertainty. On the other hand, for the investor who has a plan to buy, a different demon can appear: analysis paralysis. This is a state of overthinking and overanalyzing a situation to the point that a decision is never made. The investor with a shopping list and cash might look at the market and think, "Yes, my target company is down 30%, which is my great buy price." But what if it goes down 40%? What if it goes down 50%? Maybe I should wait for the absolute bottom. They get so caught up in trying to find the perfect entry point that they freeze. The sheer volume of negative news and the uncertainty of the future overwhelm their ability to make a decision. They watch their target price get hit, but they don't pull the trigger. Then, the market begins to rebound. It quickly blows past their entry point. They tell themselves they'll buy on the next dip, but the dip never comes. Before they know it, the opportunity is gone. They had a perfect plan, but they failed to execute because they were paralyzed by the pursuit of perfection. Buffett's approach overcomes both of these biases. His pre-made plan counters action bias. His default action is not to sell but to consult his shopping list. The compulsion to do something is channeled into the productive, pre-planned action of buying. He overcomes analysis paralysis by not trying to be perfect. He famously said, "It's better to be approximately right than precisely wrong." He doesn't try to buy at the absolute lowest price of the day or the week. He focuses on buying a great business at a price that he knows is below its long-term intrinsic value. If it goes lower after he buys, that's fine. It just means it's an even bigger bargain, and he might buy more. His focus is on value, not on price timing. This mindset liberates him to act decisively when a price enters his predetermined, quote, zone of opportunity, rather than waiting for a single, perfect point that may never materialize. To translate this into a practical framework, we need an applied mental model for execution. I call this the staggered purchase protocol. It is a systematic way to deploy capital during a downturn that removes the emotion and guesswork from the process. It's designed to get you invested while preventing the paralysis of trying to time the bottom. Here's how it works. Step 1. Define your tranches. Take your total opportunity fund cash that you've prepared and divide it into several tranches. For example, 4 tranches of 25% each. This is your deployment capital for the entire market downturn. Step 2. Set your market-level triggers. Instead of trying to time the prices of individual stocks, you will use the overall market level, such as the S&P 500, as your trigger for action. This is simpler and prevents you from getting bogged down in the details of dozens of different price points. You set the triggers in advance. For example, I will deploy my first tranche when the S&P 500 is down 20% from its all-time high. I will deploy my second tranche if it falls to 30% down, the third at 40% down, and the final tranche at 50% down. These are just examples. You can adjust the percentages based on your own risk tolerance. Step 3. Execute when a trigger is hit. When the market officially closes with the S&P 500 down, say 20.5% from its peak, your first trigger is hit. The next day, you take your first 25% tranche of cash and invest it across the 5 to 10 companies on your desert island stock list. You buy a little bit of each. The decision is made for you by the system. There is no room for hesitation or second guessing. If the market continues to fall and hits your 30% trigger, you repeat the process with your second tranche. If the market rebounds after you've only deployed 1 or 2 tranches, that's a great outcome. You've bought near the bottom, and your portfolio is recovering. You didn't get all your cash in, but you successfully capitalized on the panic. If the market keeps falling and you deploy all your tranches, that's also a great outcome. You have systematically lowered your average cost basis and have become fully invested at prices that seemed impossible just months earlier. This protocol is powerful because it solves the psychological problems of execution. It prevents you from going all in at the first sign of trouble, and it prevents you from being paralyzed and doing nothing. It provides a clear, simple, rule-based system for action in the heart of chaos. It is the engine that connects your preparation to your portfolio growth. The antithesis of this disciplined execution is a character every investor has either been or has known, the bottom timer. This individual, let's call him David, is smart. He has done his research. He has the cash ready. He sees the market crashing and correctly identifies it as a buying opportunity. But he's a perfectionist. He is determined to buy at the absolute, perfect rock bottom. The market is down 20%. David's friends are starting to buy. But David thinks, amateurs. The fear isn't high enough yet. I'm waiting for true capitulation. The market drops to 30% down. News headlines are screaming about a depression. David feels a thrill. This is it, he thinks. It's close. I'll just wait for that one final ugly day where everyone gives up. Then I'll pounce. He watches his favorite stock hit his target price of $100. But he tells himself, it could go to $90. It hits $90. He thinks, maybe $85 is the real bottom. While he is waiting for that perfect, mythical moment of ultimate pessimism, the market puts in a quiet bottom. It happens on a random Tuesday afternoon. There is no bell that rings, no headline announces it. Then, the market has a huge rally day, up 7%. David is annoyed. A sucker's rally, he scoffs. It'll retest the lows, but it doesn't. The market rallies another 5% the next day, and another 4% the day after. In the span of 2 weeks, the market is up 25% from its low. David's target stock, which he could have bought at $90, is now trading at $120. Now he's in a psychological trap. He feels like he missed it. He's angry at himself. He refuses to buy at $120 what he could have bought at $90 just a few weeks ago. So he sits, stubbornly, in cash, waiting for a dip that never comes. He watches as the market recovers all of its losses and blasts off to new highs. The greatest buying opportunity of his lifetime has passed him by, not because he was scared, not because he was unprepared, but because his ego and his desire for perfection prevented him from acting. The bottom timer is one of the saddest stories in investing. He had all the right ideas but failed at the final, crucial step of execution. He learns the hard way that in investing, good enough and done is infinitely better than perfect and missed. The direct financial connection of disciplined execution versus trying to time the bottom is one of the most studied and shocking realities in finance. The data is crystal clear. Missing just a handful of the market's best days can have a devastating impact on your long-term portfolio growth. And crucially, the market's best days almost always happen in close proximity to its worst days, right in the heart of a crisis. Research by firms like J.P. Morgan Asset Management has shown that if you had invested $10,000 in the S&P 500 from 1999 to 2018, your investment would have grown to about $30,000. However, if you had missed just the 10 best trading days during that 20-year period, your final return would have been slashed in half to only about $15,000. If you missed the 20 best days, your return would be almost zero. The bottom timer who sits in cash waiting for the perfect moment is almost guaranteed to miss these explosive rebound days. These are the days that do the heavy lifting for your long-term returns. The staggered purchase protocol, by its very design, ensures that you are invested before many of these best days occur. Let's quantify this with our crash scenario. The market bottoms at an index level of 1,000. Our bottom timer, David, is waiting for it to hit 950. Our protocol-driven investor, Sarah, deployed her first tranche at 1,200 and her second tranche at 1,100. The market never hits 950. Instead, it bottoms at 1,000 and then rips upward by 10% the next day to 1,100 and 10% the day after that to 1,210. In 2 days, the market has recovered 21% from its low. Sarah, our protocol investor, is already participating in that massive gain with a significant portion of her capital. Her portfolio is healing rapidly. David, the bottom timer, is still sitting in 100% cash, having completely missed the most profitable 2-day period of the decade. He is now forced to either give up entirely or chase the market at higher prices. The financial cost of his inaction is immense and immediate. This demonstrates that a core component of a successful trading strategy or investment strategy is not about being a perfect prognosticator. It's about having a system that ensures your participation during periods of maximum opportunity. It's about being in the arena even if you get a little bloody, rather than waiting outside for the perfect risk-free moment to enter. That moment never comes. We have now arrived at the fifth and final pillar, the one that ties everything together and unlocks the true power of this entire philosophy. The long view. This is the principle that crisis investing is not about making a quick profit. It is about acquiring ownership stakes in wonderful businesses at generational prices and holding them for the long term, allowing the compounding force to work its silent, unstoppable magic. Buying at the bottom of a crash is the event. The decades of compounding that follow are what actually builds the massive, life-changing wealth. The short-term trader might buy a stock at the bottom of a panic and sell it for a 50% gain a few months later, feeling like a genius. The Buffett-style investor buys that same stock and holds it for a 5,000% gain over the next 20 years. This long-term perspective is the ultimate source of an investor's edge. A quintessential story that embodies this pillar is Buffett's investment in the Washington Post Company in the early 1970s. At the time, the stock market was in a prolonged bear market, sometimes called the go-go years bust. Investor sentiment was terrible. Furthermore, the Washington Post itself was facing challenges and was out of favor with Wall Street. The stock had fallen dramatically. Most investors saw a struggling newspaper company in a bad market. Buffett, however, had done his homework. He had put the company on his shopping list. He saw a media institution with an almost monopolistic position in a major city, a powerful brand, and other valuable hidden assets. He recognized its immense, durable competitive advantage. In 1973, he began buying the stock aggressively. He invested about $10 million, acquiring a huge chunk of the company at a total market valuation that he believed was less than a fifth of its true intrinsic worth. He bought it for about $80 million, when he thought it was worth at least $400 million. Many people at the time thought he was crazy, but Buffett wasn't making a bet on the next year's stock market performance. He was making a bet on the long-term value of a dominant business franchise. He then did the most important and most difficult thing. He held on. He held on through recessions, through other market crashes, through political scandals, and through the rise of new media. He became a director on the board and a trusted advisor to the Graham family who controlled the company. That initial $10 million investment, held for over 3 decades, grew to be worth over $1.2 billion. That is a return of more than 100 to 1. The initial act of buying during the downturn of 1973 was the critical first step, but the true financial miracle was the result of the patient, long-term holding period that followed. He didn't just buy a stock, he became a long-term business owner. This is the final, crucial piece of the puzzle. The crisis is not the end game, it is the entry point. It is the opportunity to plant an acorn that, with the benefit of time and patience, can grow into a mighty oak of wealth. The psychological biases that work against a long-term perspective are hyperbolic discounting and recency bias. Hyperbolic discounting is an amplified version of the present bias we discussed earlier. It's our tendency to have a stronger preference for more immediate payoffs relative to later payoffs. The further away a reward is, the less we value it. The idea of a massive gain in 20 years feels abstract and less compelling than the concrete reality of a 50% gain in the next 6 months. This is why so many people who successfully buy near a market bottom are tempted to sell far too early. They see a quick, substantial profit on their statement, and the desire to lock in that gain becomes overwhelming. They choose the small, immediate reward, the 50% gain, over the far larger but delayed reward, the 5,000% gain. They are selling their ticket to the compounding lottery for the price of a few scratch cards. Then there's recency bias. This is the tendency to give greater importance to recent events than to historic ones. After living through the terror of a market crash, that experience is seared into your memory. Even as the market recovers, the fear lingers. You are more sensitive to any small dips or negative headlines, believing they could be the start of another crash. This heightened sense of risk makes it difficult to hold on for the long term. Every time the market pulls back 5%, the voice of recency bias whispers, "See? It's happening again. You should sell now and protect your gains before you lose it all." This is what causes investors to sell out during the first minor correction after a major recovery. missing the bulk of the multi-year bull market that often follows a crisis. Buffett's mind is wired differently. He operates on what is often called geologic time. He thinks in decades, not quarters. This incredibly long time horizon allows him to completely ignore the short-term noise and volatility. It dampens the power of hyperbolic discounting because the 20-year payoff is his primary focus, not a distant fantasy. It also negates recency bias because he has seen dozens of market cycles. He knows that crashes are followed by recoveries, which are followed by new highs. A recent downturn doesn't scare him. It fits neatly into a long-term pattern he has observed his entire life. Adopting this long-term view is a conscious choice. It's a choice to prioritize the destination of financial independence over the fleeting emotions of the journey. So how do we apply this long-term mindset? The mental model for this is the portfolio time machine. It's a powerful visualization and planning exercise that helps you anchor your mindset in the future, not the present. Here's how to build and use it. Step 1. Write your future self letter. This is different from the investment policy statement. This is a letter you write today to be opened on your target retirement date, say 20 or 30 years from now. In it, you describe your current financial situation, your goals for the future, and your commitment to your long-term investment strategy. You explicitly mention the companies you are buying during this current or next market downturn and why you believe in their long-term prospects. This act of writing crystallizes your long-term intent and creates a powerful sense of accountability to your future self. Step 2. Study the past to see the future. Go back and look at historical charts of past market crashes. 1987. The dot-com bust of 2000. The 2008 crisis. Pick a high-quality company, like Microsoft or Amazon, and calculate what would have happened if you had invested $10,000 at the bottom of each of those crashes and simply held on until today. See the numbers for yourself. Witness how a short period of terror was followed by 2 decades of incredible compounding. This historical study is not about predicting the future. It's about building an unshakable conviction in the long-term process of recovery and growth. It turns the abstract concept of long-term investing into a concrete, data-driven reality. Step 3. Automate and ignore. The best way to ensure you hold for the long term is to make it difficult to sell. Set up your brokerage account to automatically reinvest all dividends. This creates a virtuous cycle of compounding. Then practice the art of benign neglect. Commit to only checking your portfolio's performance once a quarter, or even once a year. The daily and weekly fluctuations are irrelevant to your long-term plan. They are noise designed to trigger your emotional biases. By removing the stimulus, you remove the temptation to act impulsively. This time machine model, combining a written commitment to the future, a deep appreciation of the past, and a system for ignoring the present, is how you cultivate the patience required to let your crisis investments mature into true, generational wealth. The antithesis of this patient, long-term approach is the impatient flipper. This is the individual who does almost everything right but fails at the final hurdle of patience. Let's call him Kevin. Kevin masters his emotions during the crash. He has cash prepared. He has a great shopping list of quality companies. He executes his buying plan beautifully, acquiring shares near the bottom. 6 months later, the market has staged a furious rally. Kevin's portfolio is up 40%. He feels brilliant. His friends who panic sold are now asking him for advice. The feeling is intoxicating. But then hyperbolic discounting kicks in. The 40% gain is real. It's on the screen, and the desire to lock it in becomes immense. He thinks a 40% return in 6 months is incredible. I should sell, take my profits, and wait for the next crash. He ignores the fact that the companies he owns are still trading well below their long-term intrinsic value. He is focused on the short-term stock price movement, not the long-term business performance. So he sells everything. He takes his 40% profit and feels like a king. But what happens next? The new bull market is just getting started. Over the next 5 years, the stocks he sold go on to rise another 300%. His 40% profit looks trivial in comparison to the massive gains he left on the table. He mistook a generational entry point for a short-term trade. He did all the hard work of buying in a crisis, only to sell the winning lottery ticket for a fraction of its ultimate worth. The impatient flipper's mistake is one of perspective. He views the market as a game of timing exits as well as entries. The true long-term investor, the Buffett disciple, understands that for truly wonderful businesses, the best time to sell is almost never. By selling early, Kevin not only sacrificed huge potential capital gains, but also triggered a taxable event, and now faces the impossible task of trying to time his re-entry into the market. His short-term victory becomes a long-term strategic defeat. The direct financial connection between holding for the long term and building wealth is the very definition of compound interest, what Einstein supposedly called the eighth wonder of the world. The numbers are almost difficult to believe. Let's run our final quantitative comparison. We have our impatient flipper, Kevin, and our long-term holder, Laura. Both invest $10,000 in a quality growth stock like Amazon at the bottom of the 2008 crisis. Let's say they buy in November 2008. 6 months later, in mid-2009, the stock is up roughly 80%. Kevin, the impatient flipper, is ecstatic. He sells his position, turning his $10,000 into $18,000. He's locked in an $8,000 profit. Laura, the long-term holder, does nothing. She refers to her portfolio time machine plan and remembers that she is holding this business for the next decade or more. Now, we roll the clock forward. By 2018, 10 years after the initial purchase, Amazon's stock has risen by more than 4,000%. Laura's initial $10,000 investment is now worth over $400,000. Kevin's $8,000 profit is dwarfed into insignificance. The difference in their financial outcome is a staggering $382,000, stemming from a single decision to sell or to hold. This is the awesome power of compounding. The initial crisis buying opportunity was the launchpad, but the fuel for the rocket ship that creates true financial freedom is time. When you combine a deeply discounted entry price with a long holding period on a high-quality growing asset, the results are not just additive, they are exponential. This is the ultimate financial payoff of the entire five-pillar system. It's how you transform a market crash from a threat to your portfolio into the single greatest catalyst for your journey to financial independence. It is the final promise fulfilled. You have made it to the end of this journey, and in doing so, you have invested something far more valuable than money. You have invested your time and your attention to acquire a powerful mental toolkit. You now possess the complete psychological and tactical framework that separates the masters of the investment universe from the masses. You understand that emotional discipline is your shield, that a cash hoard is your sword, that a pre-vetted shopping list is your battle map, that a staggered execution protocol is your charge, and that a long-term time horizon is the key to ultimate victory. You have learned how to transform the moment of maximum public fear into your moment of maximum private opportunity. But mastering this framework, the what to do and the when to do it, is only one half of the equation for building an unshakable financial fortress. The other, equally crucial side is understanding the who, the deep, qualitative analysis of the companies themselves. It's the art of identifying the unbreachable economic moats, the structural advantages that allow certain businesses to not only survive a crisis but to emerge from it stronger than ever before. The strategy you have just mastered is the key to the castle, but understanding moats is the key to choosing the right castle to conquer in the first place. The video that is now on your screen is the missing link. It is the next piece of the map. It takes you from the battlefield strategy you've just learned to the deep architectural analysis required to identify those rare, invincible businesses that are worth holding for a lifetime. Most people will stop here, content with one powerful strategy, believing their education is complete, but you are not most people. You are an architect of your own financial destiny, and you understand that a complete arsenal is required for total victory. To connect the principle of market timing with the principle of business quality, your next step is not just to watch another video. It is to continue your ascent. Click now and build the fortress.